Chapter 16, Law and Business Associations. Learning objectives are factor influencing a business manager's choice of organizational form. Some common forms of business organization in the United States. Specialized forms of business associations. Global dimensions of business associations. So factors influencing a business manager's choice of organizational form is tax ramifications, control considerations, potential liability of the owners, ease and expense of formation and operation, transferability of ownership interest, and projected life of an organization. Sole proprietorships are the advantages for these are ease in formation, total control belongs to one individual subject to less government regulation at all levels, and the disadvantages for sole proprietorship would be personal liability for both personal and business assets. Individuals pay all taxes on profits made by the business, and ownership cannot be transferred. The individual may lack the sophistication to make the next level and take the business to the next level. So creating a partnership is the Revised Uniform Partnership Act, which is RUPA, applicated in the absence of written partnership agreement, determines the existence of a partnership based on the presence of the following factors: sharing the profits and losses, share joint ownership of the business, equal opportunity to participate in management of business. And then relationships among partners, which is the duties among partners. Duties include of loyalty, good faith, fairness, duty not to appropriate partnership opportunities, not to complete in some instance, not to have conflicts of interest, and not to reveal confidential information of the partnership. Duty of obedience, which is the duty to act in accord with a partnership agreement, and duty of care, which is the duty to manage the affairs of the partnership without gross neglect and reckless or intentional misconduct. Situations that terminate a partnership would be mergers with other business, bankruptcy, and expiration of partnership agreement. And then chapter 17 is Law and Business Associations Part 2. And the learning objectives in this chapter were the corporation, classification of corporations, creation of corporation, financing of corporations, operation of corporation, limited liability companies, global dimensions of corporation, a big fat Greek bailout, 2 and 3. Corporation is a legal entity created by a state law which raises capital via the issue of stocks to its investors. Stock is the capital of a corporate, raises through the sale in shares that entitles the shareholders to certain rights of ownership. Creation of corporation. Corporations are governed by the state law. Each state has a general incorporation statute that stipulates the articles of incorporation to be used. The articles and fees are filed with the Secretary of State upon issuance of the certification of incorporation. The first boarding is held where the board of directors is elected, bylaws are enacted, and corporate stock is issued. Activities for creating a corporate incorporation: select state of incorporation, secure a corporate name, prepare articles of incorporation, and corporate powers, piercing the corporate vein. Debt financing, type of debt instrument: note, short-term loans, bonds, long-term loans secured by a line of or mortgage on corporate assets, unsecured and secure bonds, income and participating bonds, convertible bonds, collateral, and AAA bonds and junk bonds. Corporates are liable to the holder of the debt security, which requires periodic interest payments, which are tax deductible.